Our planet is heating up, glaciers are melting, and extreme weather events are becoming more frequent. But what does all this have to do with your bank account or stock portfolio? Well, my friend, everything. From carbon footprints to green bonds, from Wall Street to melting ice caps, we'll connect the dots and reveal why climate change isn't just an environmental issue. It's a financial one too. In this video, we'll explore the intricate dance between rising temperatures and financial systems. We will discuss how climate change impacts your wallet, your investments, and the global economy. The video is going to be very informative and interesting. So, subscribe to our channel now and hit the bell icon for regular updates. Let's get started. Climate change poses a systemic risk to the financial sector, prompting heightened scrutiny and enhanced mitigation efforts by regulators. Within the financial system, systemic risks are those that threaten the normal functioning of the system and result in significant negative consequences for the real economy. Two primary categories of climate-related risks reach this critical level. 1. Physical risks. These stem from more frequent severe weather events and persistent environmental changes. For instance, rising sea levels and extreme weather can damage property and infrastructure, impacting asset values. 2. Transition risks. These arise due to policy and technological shifts necessary for a greener economy. As the world transitions away from carbon-intensive practices, certain assets may become stranded, affecting their value. The magnitude of potential losses resulting from these risks, coupled with their swift impact, could significantly affect systemically important financial institutions and broader financial markets. Physical risks. The escalating frequency and severity of devastating floods, droughts, fires, and hurricanes, along with the rising sea levels, pose significant risks to insurance companies, banks, and other financial intermediaries. These risks stem from both direct and indirect exposure to affected industries and assets. Stress within a systemically important financial institution or correlated stress across smaller firms, all vulnerable to the same risks, can ripple through the entire financial system. Between 2016 and 2018, the United States witnessed 45 natural disasters, each causing at least $1 billion in losses. The average annual economic losses from natural disasters during this period amounted to approximately $150 billion, a substantial increase in both severity and frequency compared to previous decades. From 1980 to 2019, an average of 6 natural disasters per year resulted in over $1 billion in damage, with the total annual losses from such events averaging just under $50 billion. Banks and financial institutions, although indirectly exposed, also face physical risks. Severe weather events and environmental changes can trigger second-order economic disruptions in local or regional economies, extending beyond the direct impact on asset values. Research indicates that severe natural disasters lead to outmigration, lower housing prices, and higher poverty rates in affected communities. Additionally, evidence suggests that economic output tends to be stronger during cooler years compared to hotter ones. Transition risks. In addition to the physical risks, the financial system faces potential destabilization due to swift losses in carbon-intensive assets resulting from the urgent shift toward a greener economy. If policymakers take decisive action to decarbonize the economy, or if technological advancements make this transition financially appealing, assets linked to utilities, energy, transportation, and other sectors may depreciate significantly. Such actions could dramatically raise the carbon price, leaving certain fossil fuel assets stranded and impacting the value of other assets tied to carbon prices. One comprehensive estimate, considering not only fossil fuel-related assets, places the potential losses at $18 trillion. Columbia University history professor Adam Tooze suggests that up to one-third of all equity and fixed income assets are linked to carbon-sensitive industries. While a gradual transition to a greener economy might minimize market disruptions, financial institutions and investors should proactively account for the effects of this shift over time. Although some inevitable losses may occur for assets highly sensitive to carbon prices, there are also opportunities to finance green industries. However, regulators must not rely solely on optimistic outcomes. Taking significant protective measures to safeguard the financial system from climate risks will facilitate a smooth transition, reduce the likelihood of a climate-induced financial crisis, and prevent climate skeptics from opposing the necessary policies to achieve net zero emissions by 2050. Financial risk analysis. Equipped with the appropriate tools, financial sector authorities can evaluate climate risks as a critical factor in determining how to effectively manage them through appropriate policies. The International Monetary Fund, IMF, plays a pivotal role in this endeavor. Its financial sector assessment program routinely examines the resilience of banks and other institutions, utilizing stress tests to assess systemic risks. These procedures are now being adapted to include climate risk analysis, enhancing the assessment of financial stability risks stemming from climate change. Risk analysis typically involves developing scenario-based stress tests to evaluate bank solvency. These tests incorporate specific adverse macroeconomic scenarios, such as economic contractions, rising unemployment, exchange rate shocks, and falling asset prices. By examining the interplay between these macro drivers and risk factors, such as credit risk and interest income, the impact on bank income and capital is estimated. The resilience of banks is then assessed based on whether their capital levels meet regulatory thresholds. Risks from disregarding climate change. Neglecting the implications of climate change poses significant risks to the financial sector. In 2018, weather-related insurance losses amounted to 0.1% of GDP, with economic losses approximately twice that amount. The frequency of natural disasters linked to hazards rose from 249 in 1980 to a peak of 848 in 2018. Adjusted for inflation, overall economic losses surged from around $60 billion in 1980 to $150 billion in 2019, reaching a peak of $350 billion in 2018. The Intergovernmental Panel on Climate Change warns that global warming of 1.5 degrees Celsius above pre-industrial levels will lead to significant climate changes, including more extreme weather conditions. Consequently, climate-related insurance and economic losses are expected to rise as a share of GDP. Insurance and reinsurance companies must maintain appropriate risk pricing and adequate reserves to cover expected losses. Banks also need to assess the risks posed by such events to their credit exposures. These losses can result from both direct damage and the indirect effects of potentially higher maintenance costs, disruptions, and reduced labor productivity, impacting profitability and default risk. Risks from delaying the response to climate change. The financial sector faces a second risk source, related to the transition toward a carbon-neutral world. Achieving this transition requires intervention by public authorities through regulation and taxation. Early and coordinated action can facilitate a smooth economic transition. However, delayed intervention could necessitate sharper emission reductions, leading to a disorderly and disruptive transition. Certain economic activities may become obsolete, impacting asset pricing and potentially leaving some assets stranded. Financial institutions must comprehend the risks reflected in their balance sheets. Enhanced disclosure by companies regarding their climate exposure is essential, empowering market participants and financial institutions to assess risks effectively. Recent analysis of the 12 largest banks and 14 largest insurers in the euro area reveals that most disclose the impact of business travel, commuting, and energy usage. However, their exposure to climate-related risk primarily stems from their financial activities. Only 5 out of 26 partially disclose the impact of their financial assets, and none provide full disclosure. The Eurosystem is currently evaluating market understanding and pricing of climate-related risks. Attention is also given to how credit rating agencies incorporate these risks into their assessments of creditworthiness. Our ongoing assessment will inform our risk management and supervisory expectations regarding climate risks within the ECB banking supervision. Preparatory work is also underway for a macroprudential stress test to assess climate-related risks, with the first results expected by the end of the year. The stress test framework aims to assess how climate-related risks propagate through the real economy and the financial system. The stress test will draw on granular information, possibly including geographical location and carbon footprint, and focus on 90 significant institutions across the euro area. Importantly, it will also at some stage model how dynamic interactions can amplify the effects, for example, if banks react to losses by deleveraging. Potential regulatory actions. Federal regulators, including the Fed and the SOC, must proactively address climate-related risks to financial stability and safeguard the economy from the potential destructive impact of a climate shock. These actions are critical to ensure a resilient financial system. Here are some recommended steps that regulators should take. Number 1. Join the NGFS. The Federal Reserve should join the Network for Greening the Financial System, NGFS, and actively contribute to international efforts in this domain. Number 2. Address data and modeling gaps. Regulators must immediately address gaps in data and modeling to better assess the physical and transition risks associated with climate change. Number 3. Enhance coordination. The Financial Stability Oversight Council, FSOC, should direct the U.S. Department of the Treasury's Office of Financial Research to collaborate with member agencies. This collaboration should focus on analyzing climate-related threats to the financial system. Number 4. Disclosure requirements. The Securities and Exchange Commission, SEC, should mandate public companies to disclose information about the risks posed by climate change to their businesses. While legislation has been proposed, the SEC has the authority to implement this requirement independently. Investors rely on reliable and comparable information to accurately assess climate risk and minimize the chances of a future disorderly revaluation in financial market. Regulators should also seek to integrate climate risk into other aspects of the supervisory and regulatory framework. Enhance supervisory expectations for climate preparedness, climate-focused risk management standards, and higher risk-weighted bank capital requirements for assets that are sensitive to the price of carbon are all worthy of regulators' consideration. The recommendations provided in this issue brief focus primarily on banks and systemically important non-bank financial institutions. However, other state and federal financial regulators should also consider the impacts of climate change and look to use their own tools for financial institutions within their jurisdictions. Opportunities from climate change. Climate change, with its myriad challenges, also unveils opportunities. Amidst the risks, innovative efforts are shaping a more sustainable future. Number 1. Solid-state refrigeration. This technology, which extracts gases with 9,000 times the greenhouse impact of carbon, is now a reality in specific applications. By replacing traditional refrigerants, it contributes to reducing emissions. Number 2. Reforestation and afforestation. These initiatives create carbon credits that developed nations can trade with developing economies. By planting trees and restoring forests, we enhance carbon sequestration and promote ecosystem health. Number 3. Carbon capture and sequestration, CCS. This process captures carbon dioxide emissions from industrial sources and stores them underground. Additionally, biosequestration, where basic machines sequester carbon equivalent to an acre of trees, holds promise. It even produces biofuel in the process. While the risks loom large, climate change also sparks innovation. Businesses and the scientific community invest in cleaner technologies that boost efficiency while minimizing impact. Urgency is paramount. Without radical acceleration, the world in 2100 could be a hot and inhospitable place. Finance and the environment. Direct impacts. One obvious direct contribution of banking and finance to emissions is the physical distribution of cash and coin throughout the economy, though that will reduce over time as usage diminishes. A 2018 study by the Central Bank of the Netherlands looked at the environmental impact of the Dutch cash payment system and debit card payment chain. It found that cash transport had the largest environmental impact, with copper ore extraction for coin production, and ATM power consumption also significant. In the debit card payment chain, point-of-sale terminals had the largest environmental impact, followed by debit card payment processing centers and plastic card production. The study proposed several changes, such as reducing ATM numbers and transporting cash using hybrid trucks. Finance and the environment. Indirect impacts. The indirect impact of banking and finance on the environment is significant. One report found that 33 global banks have financed fossil fuels with $1.9 trillion since the Paris Agreement was adopted, 2016 to 2018, and that this amount has risen each year. At the same time, 6.2 trillion euros of investment will be required by 2030 to limit global warming to 2 degrees Celsius. Some of this will come from public sources, but the transition to a low-carbon economy requires substantial investment, which realistically can only be financed with private sector involvement. Conclusion. Climate change is a threat to the stability of the financial system and falls squarely within the jurisdiction of financial regulators. They must wake up to this emerging systemic risk and take steps to bolster the resilience of financial institutions and markets. Waiting to act will only increase the likelihood of a climate shock, destabilizing the financial system and severely affecting the broader economy. Workers, families, and taxpayers should not have to bear the burden later for regulators' failure to act today. That's all for today's video. We hope you enjoyed it. Remember to hit the like button, share this video, and subscribe to our channel for more exciting content. Thank you for watching, and we'll see you at the next one.